I have Janine on the call to talk to us about investing and specifically investing mentality around COVID-19. Like, what is going on right now? Everyone knows that the markets are in the toilet right now, whether you invest or you don't. We all hear the news. So why don't you tell us a little bit about yourself, and then we'll dive into what is happening in the stock market.
For sure. So for anyone who didn't hear us chatting before, my name is Janine Rogan. I'm a CPA based out of Calgary, and I've been involved in the personal finance space for, actually, I was looking at it last night, it's about a decade now. So writing and speaking about money and investing for about that long as well. So I'm excited to be here today. And obviously, you know, everyone make sure, please, obviously, that you are staying safe with COVID-19 and, you know, be kind to yourself as well. Obviously, this is not the time to stress financially if you can't make ends meet. So I would say definitely that's number one priority before investing.
Mm-hmm. Yeah, I guess that, you know, that's like someone's answer already. Like, should I be investing? Well, your priority should be staying safe. Just really quickly, for those of you joining us who don't know me, I'm Liz, and I run Ambitious Adulting, a platform that simplifies personal finances for Canadian millennials. Today, we're talking about investing, and the main topic is, the main question we've been getting is, should I be investing now that the stock market is on sale? What do you say to people who ask that?
Yeah, I think, you know, I always have a little bit of, being a CPA, I feel like I always have a little bit of a it depends approach, because I think obviously personal circumstance comes into it. I think, again, you know, if you aren't being able to make ends meet, this is not the time to dive into investing. As well, if you don't have an emergency fund set up that, you know, could last you 3 or 4 or 5 months, I think that's definitely a priority that people should have. And that emergency fund really should be in cash, especially obviously seeing, you know, just how much the markets have taken a hit in the past, I guess, 3 weeks now. So you would want to have that money in cash. But if you have that set up, then, you know, I don't think it's a bad time to start investing. When I look at when I started investing, kind of 2009-ish, the market was just starting to come back from the recession in 2008. And so that made me, I guess, very fortunate in the sense that I was able to kind of ride the uptick. So, you know, I think that there can be space for investing and can definitely be something that people look at, but making sure that we are covering all of our financial bases first, and making sure obviously we are able to keep a roof over our head and food on the table, and we're set up in case we do get laid off, because I mean, this is completely unprecedented times. I've never seen this in my lifetime. I talked to my parents, they've never seen anything like this in their lifetime. So, you know, being set up for the fact that potentially more of us could be getting laid off in the future.
Yeah, I also started investing in 2008, 2009. Similarly, it was, you know, right after the housing crisis, or really during it. And so I also rode that wave up. How do you think that this is different from the last dip that we saw?
I think it will probably take longer to recover. I actually don't think we're at the bottom yet. I think there are a lot of companies that are, you know, able to stay afloat right now. But soon they potentially are going to need government bailout. I know, you know, Air Canada and WestJet, for example, are, you know, still laying off people. My brother-in-law actually works for Air Canada, Jazz, and he's getting laid off as of May 1st. So they've let him know, just because there aren't flights going. So I could definitely see the bottom still coming. And I think, like I said, basically, if you look at any mutual fund prospectus in 2008, it crashed about 30%. And then in 2009, we saw a lot of those mutual funds kind of bounce back about 30 to 33%. So you basically kept your money or made a couple percent if you just kind of stayed the course and didn't freak out and sell everything. But I think that just based on how the global economy is shutting down with this COVID-19, this is going to be a little bit longer than a year of bouncing back.
Yeah, I think that's kind of where people are stressing, because they're seeing their money and it's going down 20%, 30%, 40%. I have some investments that are down 60%, which is like a slaughter in my eyes. I'm like, oh my gosh. At this point, what are you saying to people, or, you know, what are the recommendations for people who are watching their investments go down?
obviously no one expected investments to drop 60% in 3 weeks. So I would say, take a breath. And if you need to, don't log into your investment account very often. I know for my mental health, like I didn't do our net worth this month for March, because I think I would have probably gone into a spiral of like, oh my God, we need to save everything, and not very balanced when it comes to that approach. So I think if you need to, close your eyes and not look at things for a little bit, I think that that's totally fair. But I would encourage people not to panic sell as well, because again, when we look at what happened in 2008, 2009, eventually it did come back. And, if you just stay the course, those investments are going to come back. And those companies, anything on the S&P 500, the Dow Jones, like those are well-established companies. They aren't going anywhere. So I always tell people if the entire financial system collapsed, which I don't think is going to happen, we would definitely have bigger problems than you losing your investment portfolio. So stay the course and take a breath. And if you need to, close your eyes.
Yeah, I feel like I need that constant reminder, because especially if you're a do-it-yourself investor who's doing it by yourself, like you are managing your money and you're seeing it. And so sometimes you do need to remind yourself, like, step back. What I like to do is look at the history of the stock market and see all the dips and see all the bear markets and bull markets to remind myself, okay, society and humans have been through this before and it's always recovered. So I just have to have faith that we're going to recover and we're going to keep going and we're going to grow from this. Let's just get this question. So Tyler is asking, emergency fund in cash means hard cash in hand or available in the savings account, correct? Or is it stored savings in your TFSA? Okay.
Yeah, great question. So I would say I'm kind of the opinion that you should always have a couple $100 on or in cash on hand, like in your house. But more than that, I don't think you need. So I would say the emergency fund should be in a high interest savings account, although the bank keeps slashing the rates. So I don't even know what the high interest savings account, or I think they're at like 1% right now. I would encourage people to keep their TFSA for investing, just based on the tax savings that you can get from it. Sorry, I think there's like a snow blower outside.
Yeah, that's wild how much snow there is.
I know, I'm like, oh my gosh, so sorry guys. But I think keeping that TFSA for investing is going to allow you to unlock a lot of tax savings in the future. And so while the TFSA does offer flexibility, I think the best place for your emergency fund is a savings account.
Mm-hmm. Yeah, that's a great question. I think that's also a really common, not misconception, but people are putting savings into their TFSA just as cash.
Yeah.
That's not really doing anything. The TFSA is meant for investing. You can have lots of different accounts, like a high interest savings account, a checkings account, a savings account, and that's a little bit more accessible.
I've definitely said before that I wish I could rename the TFSA to the tax-free investing account. I think a lot of personal finance people would agree with me on that. But yeah, totally. The TFSA is just an account. And so within that account, you can have, whether it's savings or investments or ETFs or stocks or bonds, what have you, you can hold all of that within your TFSA account.
Mm-hmm. So it's like an umbrella, and within that umbrella, you can buy GIC,
Absolutely.
or you can buy stocks, ETFs, mutual funds. So just to clarify that for the TFSA. Okay, some other questions that people are asking. Let me see here. I had them pulled up and then the screen went black. So if you guys have questions, definitely type them in. Okay. Sure. Maybe not immediately relevant, but how does one use a TFSA for investing? I've heard this before, but I don't know where to start. Okay. I think
that's another great, fantastic question. Like I said, I think the TFSA should be everyone's priority for investing. In my opinion, if you're a young 20, 30 something, your TFSA could end up being worth 7 figures by the time you retire if you do start now. So there are a lot of different ways that you can start to invest within your TFSA. And I guess the easiest way would be to open a brokerage account within your TFSA. So whether that's using your financial institution, so if you're with RBC or TD, or even Tangerine has mutual funds that you can buy and put them under your TFSA kind of umbrella, like you mentioned, Liz. That's a fantastic way to start. Wealthsimple is a great robo-advisor that allows you to, start investing and kind of have have the robots do it for you. You just pick kind of your risk portfolio, and if you're interested in a certain type of investing, so whether that's like sustainable, or I know they have like halal investing, which is really interesting, that's an option. And then the third option I would say is DIY, which is what I do, and sounds like Liz what you do as well. So I have a brokerage account with a discount broker, Questrade, and I buy all my ETFs and stocks through there. So hopefully a little long-winded answer, but hopefully that helps.
Same with me. So the way when I work with clients, and a lot of them want to start investing and they don't know where to start, and exactly the same, you could either do it yourself. It really depends on your risk tolerance and your comfort level and how much you want to be involved. You can be completely passive and, like Janine said, go with a robo-advisor. You could work with a financial planner to help you with that, and that's more passive approach. Or if you want to be active and hands-on and doing all the research, then you could open up something like Questrade, which is definitely very, I found there was a big learning curve. You really have to know what you're doing. And then that middle ground, I think, is a robo-advisor, where there's a little bit hands-on, but it's mostly passive. And yeah, you just do what you do for all of those things. You typically do a risk portfolio, and they ask you little questions and little questionnaires. So you don't have to know everything. You do a little quiz, and then whatever platform you use, they give you little suggestions. Like, okay, well, based on what you told us, sounds like you are a balanced investor or a conservative investor. And then you just follow the steps. So that's a little bit about how that.
Yeah, and I'll just add if you are looking at starting during this COVID crisis, the best way to start is with like $25 or $50 every month or week or whatever you're able to contribute, and not throw, $10,000 at it, because again, I don't know if this is the bottom, and if I could time the market, I probably wouldn't be sitting here. I'd be on a beach somewhere, because I would be a very rich lady. But starting, small and frequently, I think is key there. And I will just mention, I am in the process of building an investing course that is going to be 60 days. Working hard to finish that right now, and it does teach individuals how to invest. So if that is something you're interested in, I can definitely pass along that sign-up information.
Yeah, that'd be amazing. And again, like I think a lot of times, people are like rushing to me, be like, "Oh, I need to invest. I need to invest." I'm like, put the halt on that. Not everybody should be investing right now. You have to kind of weed yourself out, and it's for your own benefit. It's not like, oh no, you're not invited. Like, no, you need to protect yourself and be at a place in your life where investing makes sense. And right now it might not make sense for you. So,
and I think it's important to also remember that, again, I think people are saying that because they're worried they're going to miss out on the sale. And there's that like, almost like fear of missing out on this good deal.
Yeah.
But the truth of the matter is, like I said, none of us can time the market. So yes, some stocks are on sale right now. Are they going to fall further? I don't know. But if you start investing, $50 every month, let's say, that's kind of what I started out with, you're able to leverage what we call dollar cost averaging. And so you have the ability to kind of get that average over the year. So you do not have to worry about timing the market. You catch some of the ups, you catch some of the downs, and you're able to kind of get that nice average price and not worry about timing the market. So yeah, anyone who's rushing to get into things, take a breath. The market is still going to be there when you're ready.
And the recovery, it's not like it's going to recover in a day. So if you feel like, oh, I missed out on that, okay, wait till tomorrow or wait till next week. We are in this for a while.
100%.
We are not turning around anytime soon. Layoffs are still happening, and just don't rush. That's definitely, if you learn anything from this, is don't rush.
Yes.
Okay, so another question. What about the RRSP investing? Is that the same as a TFSA?
So both of those are accounts, the RRSP and the TFSA, and they're both tax, accounts or strategies that allow you to, one, with the TFSA, you get to completely, avoid taxes when you pull money out, where the RRSP allows you to defer taxes until you are retired. So there's a lot of intricacies, around what that looks like from a tax calculation and where you should be focusing. But again, if you don't have that TFSA maxed out, the ability to ultimately save hundreds of thousands of dollars in tax is there for you if you invest in the long run. So I would pretty much always say TFSA first. Obviously, as I've said before, the answer is always it depends, because you might want to leverage the RSP to, bring down your tax bill, or look at contributing to a spousal RSP, but still the same principles in terms of it's kind of an umbrella, and you would buy investments underneath of those accounts.
Yeah, there's a lot of great free tools out there too to help you decide if you should be using your TFSA or your RRSP. Obviously, working with a financial professional might help you get that clarity for specific situations, but there's lots of tools if you type in like, should I use my RRSP versus TFSA? That lets you know kind of what route you should take. It depends on your age and your goals and your income, like a lot of different variables. But personally, I'm focusing more on my TFSA because I've already used my first-time homebuyers plan under the RRSP.
Yeah, that's a great use for it.
Yeah, and I'm like, okay, well, retirement is so far away. So right now I'm focusing on just putting money in my TFSA instead of my RRSP. So that's just a personal thing. Okay, for people who want to get into investing, but they're like, I'm still really scared about losing money, what are some tools that you can kind of suggest, or some strategies for reducing risk?
Yeah, I think when it comes to risk, you have to look at having a diversified portfolio. So that means having investments across multiple industries, multiple countries, and multiple types of investments. So you might have some fixed income investments. You also might have some equity investments, making sure you're not invested all in Canada or all in the US. You want to make sure you have a global approach. And of course, making sure you're not invested all in one industry. So I live in Calgary. Everyone knows what happened with oil and gas. So a lot of people that I know got caught in investing a large sum of their assets in just oil and gas. And so when that crashed, we saw people losing hundreds of thousands of dollars. And, obviously it was very upsetting for those people. But I would always say, that's a pretty cyclical and volatile industry. So we want to make sure we have investments across all of those different industries as well.
Yeah, and you mentioned countries as well.
Yes. Yes, sorry, I was like, that was my other point. So yeah, we have what we call the home bias for all investors. And that means, Liz and myself, we live in Canada, we're more likely to invest in Canadian equities because we're patriotic, maybe we just believe in them more, maybe we know the companies better. But really you should be looking from a global perspective on, whether it's GDP or contribution to GDP across the globe, and making sure that you are invested in all of those different areas. So whether that's Asian investments, so Japan has obviously their own stock exchange, all of the countries in Europe do as well, and you can find ETFs that have that international reach, as well as investing in the US as well.
Yeah, and I want to clarify for people who are like, I don't even know where to find ETFs. If you're going to be going with a robo-advisor or working with a financial professional who helps you choose, they will do all this work for you. You don't need to go and find like, what's a Japanese ETF I should buy? What's like an African ETF I should buy, so that you're diversified. This is a little bit more if you're going to be choosing your own investments, which is kind of more intense and labor intensive as well. But very rewarding if you like it. I've been through the journey of like them all. I started in mutual funds with banks, and I think a lot of people start there. And then I moved over to a robo-advisor. And then I was like, okay, this is nice, but like I really like finances and I really like learning. And so then it's been like a 10-year journey for me to get to picking my own stocks and picking my own ETFs. So if you're listening and you're like, I have no idea how to pick its ETFs, that's just one approach. There's lots of different approaches depending on how hands-on you want to be.
And I would say a great resource that I always send people to when they're starting to look at doing it themselves is the Canadian Couch Potato. So that website has a breakdown of kind of 3 different mock portfolios with different ETFs and all of their fees laid out. I think it's across Tangerine, TD, and then just some ETFs as well. So even just to get an understanding of what you should be looking at, that's a great place to go.
Yeah, for sure. Let's just clarify a few terms because we've been throwing out ETF around, we've been throwing stocks. Can you just kind of give us a quick little breakdown of what some of this stuff means?
For sure. So an ETF is an exchange traded fund. And so those are available kind of on any stock market that you would be looking at. And ETFs can be made up of a variety of different stocks. So I like to think of it kind of as similar to a mutual fund, like a pie. And so if you had lots of different, let's say it was a berry pie, I guess maybe I'll make a pie this weekend. So you had lots of different things in your pie, but when you cut a piece of that pie, you get a little bit of everything. And so instead of buying individual stocks for Coca-Cola, for maybe Suncor, maybe WestJet, or I guess WestJet's privately held now, or Air Canada, or what have you, instead of going out and individually buying all of those stocks, which you would need to buy a ton of those to have a well-diversified portfolio, you're able to buy units of this pie or what have you in an ETF or a mutual fund to kind of get that well-diversified approach. So when we look at the difference between mutual funds and ETFs, typically mutual funds are actively managed. So there's a person actually making the decision, whereas an ETF just kind of follows a bunch of stocks. So you could have an ETF that follows an index like the TSX or the S&P 500, or you could have an ETF that follows a group of companies. So I've seen some that are, sustainable investments, or one of my favorites is one where there is whether they have women leadership in their company. So an ETF following those things. And because ETFs are just kind of following what the market is doing, they are considered passive investments. And usually the fee on that is a lot lower than what you would see on a mutual fund.
Yeah, I love that. I love that pie analogy. I usually say it's like a fruit basket, and you go to the store and you buy a pre-made fruit basket, and all the fruits in the fruit basket are the individual companies. And you didn't pick them out because they were already made in the fruit basket. So you're just picking up the fruit basket and taking it and enjoying the benefits of that.
Yeah,
so,
for sure. We
but
are,
then again,
all the fruits today,
all the fruit,
whether it's a basket or a pie.
Yeah, and I'm so visual. So all these little analogies help. One of the analogies my friend who's a financial planner taught me that like really stuck with me, especially during this time of volatility, is the man walking up a hill with a yo-yo. She's like, the man is going up the hill, and the hill is the stock market. The yo-yo is like the volatility of the day to day, but ultimately he's still going up the hill. And I'm like, okay, yeah, I'm like, I gotta remember that. I'm like, hey, it's just a man with the yo-yo, and sometimes the yo-yo gets stuck and he's like unraveling it. And right now we are in this like unraveling stage of a messy yo-yo string. So he's still walking up. Okay, a few more questions here.
Awesome.
Is it ever a good time to use a line of credit to invest, assuming you have your 3 to 6 month emergency fund?
So I think obviously the answer is it depends, which I know people love hearing that, but obviously depends on your risk tolerance for taking on debt, the interest rate you can get on the debt, which I think is pretty low right now. But there are some benefits to doing it. Obviously, if you are borrowing to invest in an income generating asset, you can write off that interest for tax purposes here in Canada. So it may make sense, but I would say, make sure that you have the ability to pay back that debt. And obviously in these times, make sure that you'd be able to continue making payments on that debt, should you lose your job. So maybe making that 3 to 6 month emergency fund have 3 to 6 months of that debt repayment. I'm assuming it's an open line of credit that you would be required to start kind of paying back on a monthly basis. You would want to make sure that under all circumstances you can pay back that money, and you're okay with the market still potentially going down.
Yeah. It seems a little risky. I've done it. Like I use my own stuff to invest. We've used a line of credit to invest. So I'm definitely not against using debt to invest. Personally, I just feel like it's so volatile right now. I wouldn't feel personally comfortable. But Flo, you do you. Like this. It's a possibility. It depends on how comfortable you are with that. Okay. Does it make sense for individuals to manage their own RRSP as opposed to through a financial investing company? Why do people manage their own RRSPs?
So I'm assuming the financial investment company is kind of like a managed plan through work. And so like a Sun Life, a Manulife. And the benefit of that usually is that you get some sort of matching from your employer. So you definitely want to sign up and leverage that, because that's basically free money that you can get from your employer. Above that, though, if you want to open another RSP and manage that part yourself, you absolutely can. And it's the same sort of thing when it comes to the TFSA. Usually, if you're doing it yourself, you have more control, you can get lower fees, and you can have the decision as to what you want to actually invest in.
That's really the big difference between passive and active investing. If it's passive, the way I explain it is you always pay more for convenience. It's like cooking at home. If you're cooking at home and doing everything yourself, it's going to be cheaper than you eating out or you ordering in.
Uber Eats.
Or Uber Eats. Like you're paying premium for that. Not only
Yeah.
are you paying to order in, now you're paying for the delivery, plus their service charges that I'm still like confused why they charge me tolls. I'm like, tolls? There's no tolls around here. So the more convenient it is, the more expensive it usually is.
Yeah, and so I guess the other option, if it's not an employer managed plan, would be, going with an actual investment advisor, so someone who manages your investments, and those are usually the most expensive individuals. So if you're doing that, you really want to make sure that you're getting, bang for your buck. They're able to deliver at least market returns, if not higher than market returns, because you're probably paying a few $1,000s a year to leverage those services.
Mm-hmm. And see what, not only like that the returns are good, but are you getting any more kind of customized support? Are they reaching out to you to see if anything has changed in your life? Like I went 6 years with no one calling me. So
yeah, that's crazy.
I'm like, hello.
Definitely interview your financial advisors or whoever's running your investments, and don't be afraid to fire them either.
Mm-hmm. All right, so we have about 8 minutes left. Let us know if you guys have any more questions. Keep typing it into the comments.
These are awesome questions.
Yeah, these are great. These are awesome questions. Let me think about what other people ask. Really about, should they be buying their stocks? I think right now it is what you were talking about, that FOMO. Like everyone's feeling like, oh, I need to get into the stock market right now. But I have a quiz, actually. I just did a quiz that you can do to see if it's a good time to invest. And I know Wealthsimple put out a little diagram. It's like a little follow your own adventure.
Okay.
Essentially, you want to have, they'll be like, do you have debt? Yes, no. And then if it's like, yes, like what kind of debt is it? Is it high interest debt, low interest debt? If you have high interest debt, probably not the best time to invest. If it's just like a mortgage, okay, proceed with caution. And you kind of work your way down. So I can send out my quiz in a bit. And also you can take a look at the Wealthsimple quiz. To really understand, like, is this a good time to invest? Because don't just rush in. And if it is, then, Janine has resources, I have resources to help you understand the next steps to take.
Yeah, I've had a lot of people reach out to me asking about, individual stocks. And I would say to like, oh my gosh, should I buy Netflix or Tesla or, something like that? Zoom have been doing really well.
I bought Zoom.
Good for you. But I think the approach to that is if you don't have a portfolio set up, like a base portfolio with, well-diversified ETFs or mutual funds or what have you, now is not the time to jump in and just start buying random individual stocks, because that is super risky. Putting all your money in Apple, that's one stock. If they get bad press or, maybe we're lucky that they're, what happened in China with the pandemic didn't shut down their operations. It could have. And if that had been the case, maybe we would have seen Apple absolutely tank and lose a ton of money. So, investing in individual stocks when you don't have a base portfolio set up, I think is incredibly risky. So while we see all these stocks dropping, it's important to kind of, zoom out and take a look at the bigger picture and set yourself up for long-term success, not just one stock here, one stock there.
Yeah, and I think everything right now is so unpredictable. So even if you're doing a ton of research and you really believe in this company and, this company has been doing well and the performance is amazing, like who knows what's going to happen? Like everything is so unpredictable. So yeah, absolutely. Investing in one company just because you saw somewhere on the news that they're doing really well might not be the best approach right now.
And chances are, if you're hearing about it on the news that they're doing really well, you've probably missed the boat on it. Like I heard about Zoom and I was like, I should have bought Zoom. But by the time, I even looked into it, it had already jumped, 20% or what have you. So
yeah, I got it on, I could go on about sometimes I jump the boat and sometimes I'm impulsive. Sometimes I do a lot of research. People always ask me like, "Oh, what's your process?" I don't think I have a process. My base process is most of my portfolio is made up of ETFs. Kind of like you were saying, they're well diversified. And then I give myself some wiggle room of like play money, which is higher risk, that maybe it pans out and maybe it doesn't. But overall, my portfolio is diversified and balanced enough that I can make these riskier decisions. But again, I've been kind of doing this for 10 years, so I just know that I can handle it. So don't just jump in thinking that you can just go and build your own portfolio and become rich because we're going to recover from this.
Yeah, that's exactly my approach as well. Having that a bit of fun money to play with, and being okay that if it did go to zero, if you lose $2,000, you lose $2,000, but you're individually picking stocks, and so you need to kind of know the risk associated with that.
Mm-hmm. Yeah. And I've made mistakes. I've lost
Well,
money.
same.
So, it's an expensive, I've learned some expensive mistakes. Definitely on speculative stocks that were doing super well. And I took my hand off, or my finger off the pulse, and they just tanked right after. I'm like, why did I do that? So
Yeah, it's so hard to know. Like I've had stocks that have really taken a tumble, and in most cases those have been like there was some sort of fraud or like accounting fraud, and I'm just like, how would I have ever known that? So I guess the other part of it is if you do lose some money, know that it happens. It's okay. None of us again can see into the future. So
yeah, that's why I like to remind myself of the timeline. I'm like, okay, I'm in this for the long run. I'm going to
100%.
make it back. Maybe it like hurts and it like pains me for a while, but I got to keep moving. So that's just the way it is. Investing is not, do-it-yourself investing, I should say, is not for the faint of heart. Passive investing, maybe everyone could be, fine with that. But when you make your own choices and your mistakes come back and haunt you, that's not for
Yeah.
the faint of heart. Okay, well, we're running out of time. Oh, speak to paper loss versus real loss. Oh, yes. Can you spend a tiny bit of time on that?
Yeah, for sure. So, paper losses would just be unrealized losses. So if you see your account go down, technically you've lost money on that, but it has not been realized. Therefore, it's not real in a sense.
Right.
Whereas if you've actually sold that stock or sold that ETF, you've technically then lost the money, if that makes sense. So another way to think about it is if you're outside of your TFSA and RRSP, if you do lose money on a stock and you sell it, you can use those losses to balance any capital gains you would have to pay tax on. So you can't do that until you sell the stock. So hopefully that makes it a little bit more clear that you have to actually sell the stock at a loss to realize those losses and ultimately use them.
Mm-hmm. You don't lose unless you sell. So that's gonna, close us off. Where can people find you if they want to work with you, if they want to learn more about investing? Let them know.
Yeah, I would say Instagram is probably the best place to go. So it's just at Janine Rogan. I also have a YouTube channel, which is again just my name, Janine Rogan. So definitely feel free to reach out to me there. I believe Liz has sent us all your emails, so I will pass along some information around my investing course. And if you're interested, please feel free to sign up.
Amazing. Thank you guys so much for watching, and keep watching it on YouTube. It's going to be on YouTube, and follow me on Ambitious Adulting on Instagram for more information. Thank you.
Everybody, bye.